Uh, anyways, Scott and Steve, we know them in particular through the Socialist Register and their work with that. They wrote a fascinating book about the U.S. Financial system, the U.S. banking system, that they did a presentation for at on our behalf. And I will, without more ado, I'll turn this over to them. They can say anything more they want to say about their own work and how they got involved in this topic of the market power of Amazon.
Okay, thanks, David. Yeah, so I guess I can just pick it up right there, which is that, Scott and I have been really interested for a while in questions of competition and monopoly and corporate capitalism. Our book, The Fall and Rise of American Finance, deals with, it develops a critique of the idea that we're currently living in a phase of monopoly capitalism by showing how the development of the financial system and the large corporation actually intensifies the competitiveness of capitalism in the sense that Marx talks about it in Volume 3, where the development of the financial system eases and facilitates the circulation of capital across the different branches of industry as well as geographically, and thereby disciplines all of the possible outlets into which that money capital could flow to maximize returns or face the withdrawal of investment. And we were building very much on, Anwar Sheikh's theory of real competition, and taking a historical and institutional lens to understand how competition and the mechanisms and channels whereby competition occurs and capital flows develop over time, and what makes them develop the way that they do. And so, I was talking, the way we got involved with Amazon was basically we're kind of connected to a group in Ontario, Southern Ontario, of people who are working to organize an Amazon, a couple of Amazon warehouses in the Southern Ontario region. And they wanted us to do a research project to understand what is Amazon. And so we figured, why not? We'll support their efforts. And also, Amazon's a puzzle, and Scott and I hadn't worked on, that kind of sector before, the retail sector, merchant capital, as Marx calls it. And interestingly, merchant capital is very similar in many respects to financial capital, actually, in that they both deal with circulation. And the ways that competition manifests at both of these different levels are actually incredibly fascinating. But in both cases, I think we see a very strong refutation or critical light cast on the idea that that bigness, corporate bigness, it somehow inherently translates into greater monopoly power. And I think what's really unfortunate is that, if you go back and you just look at the history of the development of Marxian economics, it's really unfortunate that basically since Braun and Sweezy wrote Monopoly Capital, the entire tradition of Marxian economics has basically jettisoned Marx, at least large and important parts of Marx. What's called Marxian economics has some connection to what Marx wrote, but important parts of Marx's theory, which are actually, to be honest, in our opinion, the core of the theory in many respects around competition, have been jettisoned in favor of this idea that we're now living in monopoly capital. And what's worse, these people who draw on, who develop this theory of monopoly capital, most influentially the Monthly Review School, beginning with Paul Baran and Paul Sweezy with their seminal text, Monopoly Capital, which had such an impact. They effectively rely on neoclassical economics. And so they effectively jettison, Marx's distinctive approach to economics, building on the classical economists, Smith and Ricardo, and developing their ideas. And they replace Marx's theories with neoclassical ideas of value, but also neoclassical theories of competition and monopoly. And primarily the form that takes is this idea of imperfect competition. That, there's the classic kind of dichotomy, or I should say spectrum is how it's usually framed, is that on one side you have, perfect competition, right? Neoclassical, perfect competition, perfect information, rational individuals, frictionless markets, and so on, right? And it's an infinite number of small sellers and an infinite number of small buyers, none of whom are able to exercise power over the others and simply passively receive, take prices. And then on the other end of the spectrum, you have so-called imperfect competition, which has been associated with Keynesian economics. And imperfect competition basically holds that, well, sure, it doesn't work the way that the neoclassical economics textbooks say. We have an imperfect version of that. So maybe there was a Garden of Eden some time ago where we had perfect competition, but unfortunately now we're in this fallen state. Eve ate the apple, and we're no longer in the Garden of Eden. Now we're in this imperfect reality of large corporations. And so effectively it's a kind of religion where the actual observed functioning of capitalism is deemed imperfect by virtue of its non-correspondence with some ideal state that never existed and never could exist. So against those two approaches, Sheikh developed a theory of real competition, which it attempts to describe and understand the way things actually work, and therefore the real way that capitalism functions. And in doing so, he draws on Marx. Now, to understand Amazon, Scott and I are using Sheikh's theory of real competition to criticize, by looking at the case of Amazon, the idea that there is a relationship, a direct correspondence between the number of sellers in a market on the one hand and the level of competitiveness, if you like, on the other hand. So that as the number of sellers in a particular market declines and you have markets dominated by a smaller number of larger firms, competition declines with it until you ultimately have a monopoly situation where there's only a small number of, if not just one seller or buyer in a particular market. And of course, if you have a monopoly firm that's not disciplined by competitive pressures, all of the basic engines of accumulation that Marx lays out across the 3 volumes of Capital cease to function, right? Because it's the coercive laws of competition that ultimately propel forward accumulation and which ensure that regardless of whether they're nice people or bad people or whatever state of mind they're in, even capitalists remain captive to the structural imperatives of the capitalist system to accumulate or die, accumulate or perish, right? That's Moses and the prophets, as Marx says. And so competition is central to understanding the way that large corporations operate. And indeed, as we argue, these firms don't really face meaningful barriers to entry or exit. They're able to, sure, the cost of entering very concentrated sectors are a lot higher, but when you're talking about giant corporations that have immense financial resources at their disposal, that just means that the weapons of war have gotten larger and more sophisticated, not necessarily that the war has been suspended. So in the context of a situation in which you did have a monopoly firm, let's say, if we accept the neoclassical theory and the monopoly capital theory, which are the same, then you would expect that you would see a monopoly firm acquiring super profits, right? They were able to basically do, fixed monopoly pricing, which would be artificially high, and therefore they would get super profits and rents that they would collect as a result of that. You would see stagnation, you would see inefficiency, you would see there's no real incentive to invest in improving the productivity of labor and develop new technologies because there's no competition. So they're making profits and they can fix prices, so they have no need to restructure or to intensify the exploitation of labor because they have monopoly pricing power. But in fact, what we see when we look at Amazon, which should be the case that would be a prove, right, what these people would be arguing, that there is a monopoly, because of course Amazon has no direct competitor. It's a giant firm. And it meets the criteria of what you would expect would be the case of imperfect competition or no competition. But in fact, what we see in the case of Amazon is the opposite of what those theories would predict, right? Rather than stagnation, inefficiency, et cetera, we see Amazon continuously fighting to sustain and renew its power through unceasing innovation and continuous restructuring and revolutionizing the labor process, right? And massive investment in doing so, right? And technological development. So Amazon competes just on the surface level, right? Excuse me. I'm a bit sick. I have a bit of a sore throat, so I'm just going to sip on my tea while I talk. Amazon, just on the surface level, competes with other firms, both in its sector, that is to say retail or e-commerce, And it also competes with firms across sectors, right? Amazon competes with, Walmart, but it also competes with logistics and delivery companies like UPS and FedEx, right? It also owns a movie studio, so it competes with Disney, right? It competes with Google, with search engines, right? Google. It competes with Netflix. It has a streaming platform called Amazon Prime. It competes with Microsoft. And indeed, Amazon today delivers more packages than UPS and FedEx. So it's competing very effectively in a quite a cutthroat way, actually, with across all these different sectors. And of course, Amazon has the cloud, the Amazon Web Services division, which makes up, I think, 68 or some odd percent of its profits by the estimates that we were using, and so on. But of course, the merchant activities of Amazon make up 85% of its net sales. So the bulk of its business, in terms of the money that it deals with, the money it expends, and the money that the income that it makes, is in retail. So what we can conclude from this, and I'm going to go through in a little bit of more detail by drawing on volume 2 in a second, is effectively that there is no correlation between firm size and the level of fixed capital investment on the one hand and competitiveness on the other. There's no correlation. That having a smaller number of larger firms does not mean that competition is reduced. Because if it did, we would observe very different empirical phenomena than we see in the case of Amazon. So capitalist firms, capitalism is characterized by a war among firms, and those firms compete for market share in all the areas that I was just mentioning in the case of Amazon. But there's also, as Marx kind of brilliantly lays out in volume 2, a competitive tendency to accelerate turnover time, right? To reduce the time between investment and sale, right? To compress that time as much as possible. The faster capital undertakes that cycle from M to C to M prime in a given period of time, the more surplus value is produced in that given period of time. So capital has a strong incentive to undertake that circuit as quickly as it can. And competition disciplines it to do so. And merchant capital plays a particular role in that, which I would classify Amazon as being, and as I'm going to say in a minute. So this has to be understood then in Marx's terms as a pressure to accelerate turnover time, as he calls it. And turnover time is comprised of production time and circulation time, right? Production time is the time it takes to produce the surplus value, and circulation time is the time it takes to convert money into commodities, labor power and the means of production on the one hand, and commodities back into money on the other end of the production process. So Marx, of course, we all know the general formula of MCM prime, but Marx in volume 2, as I'm sure everybody here is aware, breaks that down still further and in more detail with a lot more clarity in volume 2 in the extended form of that formula, M, C, P, C prime, M prime, right? That is to say, from the money form to the commodity form, when money is transformed into labor power and the means of production, capital then enters the production process and becomes productive capital, through which process a new commodity is produced. Commodity capital, as Marx calls it, because it is pregnant with surplus value, right? It's a commodity that is laden with surplus value waiting to be realized in a sale. And then finally, M prime. So we have M, C, P, C prime, M prime. And that C prime is that commodity capital, the commodity that is the output of the production process. So circulation time then, so as I said, turnover time is circulation time plus production time. And circulation time, Marx says, equals selling time plus buying time, right? The two different points at which capital enters the sphere of circulation, both before and after the production process, right? So the part before the production process, when money capital is awaiting transformation into labor power and the means of production, Marx calls buying time. On the other end of the production process, when commodity capital is awaiting conversion into the money form, Marx calls selling time. And so circulation time in total equals selling time plus buying time. And that's going to become relevant in a minute when we describe Amazon in a little bit more concrete fashion. So just as capital strives to minimize production time as much as possible by developing new technologies to accelerate the production process, so too does those competitive drives force capital to reduce circulation time, right? So capital tries to compress and accelerate the circulation velocity of capital through developing the physical infrastructures of circulation. So transportation, logistics, communications, all those things serve to facilitate and accelerate the circulation time of capital, and therefore to increase the production of, accelerate the production of surplus value. So all this means that capital, as David Harvey, I think, brilliantly put it in an old essay in the New Left Review, capital is not a thing per se, but it's value in motion. It is a process, right? It's a series of functionally integrated stages across which it takes different forms. And that's what Marx brilliantly lays out in the first two chapters of Volume 2, which I find incredibly stimulating, despite its reputation for being incredibly boring. And so each stage of the circulation process, from money to commodities to money, from money to commodities to production, back to commodities and to money, each stage of that circulation process is carried out by a particular economic sector. So they become, each stage becomes a kind of specialized function of a particular branch of capital. So money capital, for example, becomes a specialized function of finance. Commodity capital becomes a specialized function of merchant capital, and productive capital becomes a specialized function of industrial capital. And so industrial capital produces surplus value, while merchant capital and financial capital profitably circulate commodities and money during the moments in capital's circulation process when it is in the sphere of circulation. So in practice, and this is again going to be important in a second when we talk about Amazon, merchant capital also produces surplus value, right? In practice, merchant capital is not just buying cheap and selling dear, although it is that, the pure merchant activity of buying cheap and selling dear. But merchant capitals very often, if not practically always, undertake activities such as the storage and transport of goods in a distributable form, as Marx puts it in Volume 2, which he argues is productive of surplus value. So Amazon is also undertaking productive activities in addition to its pure merchant activities. So the circulation of capital then takes place through the unplanned and competitive interaction of individual capitals. And these are linked into what economists call value chains, right? So the inputs purchased by one capital are the outputs sold by another capital, right? And this creates the possibility for disruption in the circulation process, but it also creates the opportunity for the exercise of power. And so just as firms compete for market share, as I was just saying in the beginning, across different sectors, they also compete within their supply chains with their customers and their suppliers to maximize the amount of surplus value they can capture within the overall circulation process. So firms want to leverage strategic points within their overall circulation process of capital in order to increase their bargaining power relative to suppliers and customers. And so they want to basically charge their customers the highest prices they can get away with, and they want to pay their suppliers the least possible, right? And that means that they're able to retain the largest possible share of surplus value within their particular firm without letting it leak out to their suppliers and to their customers. And so this competitive process between suppliers and sellers within value chains shapes the distribution of surplus both within and across sectors. And it means that even the most concentrated sectors are not static, but highly dynamic. So to maximize profit, merchant capital in particular has to reduce circulation costs and reduce turnover time, right? By doing that, it attracts other capitals to utilize the infrastructures and so on that merchant capital possesses and controls in order to increase their own profits, right? By reducing their circulation time, reducing their costs, and therefore allowing them to increase their profit rate. So what that means then is that by accelerating circulation time, merchant capital compresses space and time for all the capital that uses their infrastructures. And it's that competitive ability to offer productive capitals or other retailers to reach wider markets or to increase their turnover time that merchant capital is able to gain control of commodity capital and make profits. So it's constantly disciplined to accelerate this process, to compress space and time. And Amazon in particular faces particular challenges in this regard, faces particular pressures in this regard. And now we're going to transition to talking about Amazon specifically, right? Amazon's basic gambit is that they can deliver a product right to your door without raising the price. So they can do everything that brick and mortar retailers do. But they could bring the product right to you without the price going up. And indeed, Amazon has consistently ranked as the lowest priced retailer since 2016 compared to Walmart. So this has required Amazon to invest a lot of capital in developing an infrastructure for circulating commodities quickly and efficiently. It offers sellers who sell through Amazon's network. It offers sellers the opportunity to reduce their costs, increase their turnover, and reach wider markets, even despite the fees that Amazon charges. And it allows consumers, it attracts consumers by offering low prices and fast delivery. And it's out of this process that Amazon Web Services was developed and that it continues to play a major role in, as Scott's going to talk about in a second. And just not a moment too soon because my voice is about to go. So, okay, Scott.
Thanks, Steve. So Amazon's basic business strategy that Steve was laying out there requires absolutely massive investment in new warehouses, R&D spending, fixed capital. Amazon is today the leading corporate R&D spender. It has increased its R&D spending, in fact, in every year since 2009, growing it by an average of about 36% annually. And in 2023, Amazon's R&D spending eclipsed $85 billion, more than Microsoft, Apple, Pfizer, and Intel combined. So this spending on R&D is focused heavily on accelerating circulation velocity for the reasons Steve mentioned, right? And reducing circulation costs through robotization, through AI, through algorithmic discipline, etc. Amazon's very high levels of investment also serve to reproduce barriers to entry as they impose onto others a very high cost of entering its and challenging its dominant position and entering into the space that Amazon occupies. Moreover, and very importantly, in terms of organizing, the high levels of investment Amazon maintains enable it to operate with substantial excess capacity. And what this does is afford their kind of operating and logistics and warehouse system considerable flexibility to reroute the flow of commodities in any way necessary to circumvent blockages or interruptions, including those caused by workers. So that's an important point, and we'll come back to that near the end of the presentation as well. So getting to Steve's point again, Amazon is continually restructuring and evolving its operations. It's always developing the technical basis of production and circulation to reproduce its dominant position and to maximize its profitability. But it's also doing this to defend its position, to defend itself against other firms. Amazon, to be sure, has constructed a unique infrastructure for circulating commodity capital. Yet it's vulnerable, right? This uniqueness cannot be and should not be overstated. Its business model could be replicated, and it faces pressure from other firms who are themselves rapidly accelerating circulation and delivery. And of course, with the depth and size of credit markets today, it faces a constant threat from other large capital firms as well. Now, still on this point about investment, most fundamentally, and Steve and I certainly differ in this respect from others who have written and talked about Amazon, but most fundamentally we show all of this investment and restructuring and its orientation towards continuous flexibility, etc., is geared towards intensifying work discipline, increasing productivity, and exploiting its labor force, right? Amazon's competitiveness is rooted in the end in the exploitation of labor. It is critical when looking at Amazon, we believe, not to downplay in any way or distort the essentiality of the capital-wage relation. Strict work discipline is necessary for accelerating circulation velocity and for reducing circulation costs. And it is this, right, reduction of circulation time which incentivizes its third-party sellers to pay the fees that Amazon ASIC to pay. And also, the reduction of circulation time incentivizes its first-party sellers to sell inventory at a low cost. And of course, it's all this compression of circulation time which enables the reproduction of Amazon's other competitive advantages, which I'll turn to just in a few minutes. Now, and as Steve noted as well, Amazon also engages in productive activities. Its transportation and logistics operations add value to commodities. So intensifying work and increasing labor productivity thus also produces for Amazon surplus value. Okay, so for us, Amazon's network of warehouses, its giant fulfillment centers, its giant sortation centers, etc., are at the very core of its business model and are the key source of its competitive advantage. Steve already noted the revenue streams generated through its warehousing and logistics operations. These represent 85% of net sales. Moreover, it's through this integrated warehouse and e-commerce system that Amazon's able to profit from the buying and selling of goods from first-party sellers and to capture fees from third-party sellers. Right? In 2023, fees alone amounted to $185 billion, which was 2 times AWS revenue and 7 times AWS profits. These fees alone were basically sufficient enough to cover all operating expenses for Amazon's logistics and retail system, as well as basically all new investment. Now, as we show, the increasing fees sellers face, which can be upwards and slightly more than 50% now, have not led and do not lead to higher market prices. Instead, these fees have intensified downward pressure on costs, with the result that North American sellers are today really unable to compete with Chinese and other firms with lower costs of production. Now, another aspect of the globalization of Amazon supplier and seller value chain is reflected in what Amazon calls its inbound cross-dock, its IXD facilities, and these have expanded tremendously with Amazon's own growth. These IXD facilities receive and store inventory from foreign vendors, and because so many of Amazon's sellers, especially its third-party sellers, are offshore, these inbound cross-dock facilities have grown alongside the growth of Amazon's platform and warehousing network. So far from Amazon's market power leading to higher monopoly prices, therefore, competitive disciplines have driven the globalization of Amazon's value chain, the intensification of time-space compression, and have forced prices down. And this is, of course, exactly at odds with some of the findings, some of the research that's currently out there on Amazon, which Steve and I, of course, are pushing against. So, when I come back into the buying and selling time point from volume 2 that Steve referenced in talking about what we call Amazon's monetary hoard. And this, of course, is still on the point that Amazon's warehousing logistics network, its core, is central to its overall operations. So in addition to extracting fees and negotiating favorable wholesale prices, Amazon's control over commodity capital through its warehousing network and its logistical system enables it to accumulate a monetary hoard. And we estimate this monetary hoard to be about $30 billion annually in 2023. So this hoard significantly supports Amazon's high levels of investment. Amazon amasses this $30 billion hoard by managing the difference between its circulation time, its buying and selling time it achieves, and the circulation time, the buying and selling time, which it imposes on its suppliers. So that gap between the two allows Amazon to accumulate this monetary hoard. So as Steve mentioned, circulation time is selling time plus buying time. So Amazon reduces overall circulation time, both buying time and selling time, but it speeds up selling time more than it does buying time by converting really quickly commodity capital into its money form, right? The C prime into the M prime. It really speeds that up quickly, speeding up selling time. And it kind of freezes the circulation process by retaining the money capital it achieves here under its control for a certain duration, thus slowing down buying time, jamming up buying time a little bit, right? In effect, what Amazon's doing here is holding cash owed to suppliers for the sale of commodities for weeks and even months, thereby gaining continuous access to interest-free capital and displacing the debt and interest load onto weaker supplier firms. So the difference between the circulation time it achieves and that which it passes on to its suppliers is measured in terms of what mainstream neoclassical economists call the cash conversion cycle, or CCC. So CCC specifically quantifies the difference between the time a firm's capital is tied up in the form of commodity capital and the time it takes to pay sellers. The lower the CCC then, the longer a firm holds on to cash after selling its inventory and receiving payment, but before paying its bills. Okay, the CCC is a very good measure of the leverage that a firm has over its suppliers and its customers, and it therefore indicates the relative power of a firm to demand or to delay payments owed. Now, what we find is that Amazon has amongst the lowest CCC of any major corporation. In 2023, Amazon posted a CCC of negative 14.7, and negative is good, right? It's a really good number, as compared to the retail sector average of plus 44.9, right? And this, of course, reflects Amazon's market power and its ability to speed up buying time and selling time, but selling time faster, right? But it does this, it maintains, and the effect of this is a monetary hoard, is interest-free monetary hoard. But it achieves this while still, again, accelerating the compression of time and space for its sellers and suppliers. So Amazon, in effect, passes on only a portion of the total gains in circulation time and its suppliers. This reduction is sufficient to provide its suppliers with a competitive incentive to rely on Amazon for the circulation of its commodity capital. And it's also, right, it's also enough to allow Amazon to accumulate a significant interest-free monetary hoard. So a further point on this, and we can kind of spend a bit more time on the CCC and buying time, selling time in the question period if necessary. I just want to push this a bit further. It's important to understand that Amazon's strong liquidity position and the cash hoard it is able to obtain by jamming up buying time, in a sense, enables it or helps to enable it to sustain a very high stock price, which in turn benefits Amazon in other ways as well. So currently Amazon is only one of 5 companies with a market capitalization exceeding $2 trillion. Yet it has never paid a dividend and has only once participated in stock buybacks a couple of years ago in the amount of a paltry $7.2 billion. And that really is actually not, I'm not being sarcastic, a very small number in the buyback world. In contrast, in fact, Apple, which is another one of those $2 trillion market cap companies, has spent $500 billion on buybacks in the last decade alone. Walmart, its main competitor in the retail space, has devoted $102 billion to buybacks since 2009. So by not transferring the surplus to investors through buybacks and dividends, Amazon's able to retain these funds, further strengthening its liquidity position and supporting its high levels of investment. And again, this reinforces the importance of the warehousing and logistics to Amazon's overall operations. Its CCC, its high CCC, its high cash hoard allows it to maintain an attractive and high stock price, and it benefits not only from the interest-free capital associated with that hoard, but by the high share price and thus the ability not to have to pay dividends and participate in extensive buybacks. Okay, I'm going to work towards a conclusion on some of these points before passing it back to Steve. Now, as people know Amazon is also dominant within the cloud sector through its Amazon Web Services, or AWS division. So what AWS does is sells computing capacity, and it therefore allows firms to purchase computing capacity on demand without having to directly invest in IT infrastructures itself. This is not different than what it's doing with logistics, right? It's selling warehousing logistics on demand and delivery on demand so that firms don't have to directly do this themselves. So AWS maintains a 30% market share currently. Microsoft and Google have 25% and 11% respectively. So Amazon's in the lead currently right now. And AWS has definitely been highly profitable, right? AWS profits account for the lion's share of Amazon's overall profits. So for some, the cloud sector, Amazon's AWS, in particular here, is the paradigmatic example of a monopolistic rentier market, right? For us, though, this is not the case, right? What we observe by looking closely and carefully at AWS is not the stagnation of an uncompetitive monopoly, right? But AWS demonstrates the characteristic dynamics of capitalist competition, right? So competition has propelled technological development and capacity expansion in AWS. It has also reinforced the integration of AWS and Amazon's other operations. These have always been completely integrated, but they've become even more completely integrated as competitive pressures have intensified. Amazon now sells AWS as part of a suite of services that allow businesses to organize their operations through Amazon. This in turn has reinforced Amazon's need to continue investing in its cutting-edge logistical capacities. So while it's true that AWS supports the competitiveness of logistics, AWS underpins Amazon's e-commerce platform, and it also enhances inventory and route management and demand forecasting. It is also the case that Amazon's logistics support the competitiveness of AWS, right? These two are integrated. They're integrated so much that any investment in AWS is actually an investment in Amazon's logistics and warehousing operations, and vice versa. Steve, you want to take it over from here to finish up?
Yeah, we can. The way we've done this kind of discussion in the past is we've kind of closed with some reflections on organizing. But I think we can maybe we could bracket that and move to discussion, because we've taken up a bunch of time. And see if people have any questions or want to chat more about that particular angle, and we can move it in that direction if that's what feels worthwhile. I think the most important thing that we wanted to get across with this particular discussion was the application of the Volume 2 principles and concepts.